Lara, great to have you back on the show. What are you looking for from Jay Powell this afternoon?
Yeah, unfortunately, it's probably not going to be a blockbuster of a Fed meeting. We don't have new economic projections. And given that they really kind of locked in their asset purchase expectations at the last meeting, I don't expect much of a change there. I think what we're really going to be looking for at the press conference is any sort of indication about, stimulus, coordination with the new Treasury Secretary, what that could possibly entail, and of course, whether or not they're really on hold or they are expecting a strong economy in 2021. I think the recent data have caused a lot of us to reanalyze where we think the trajectory of 2021 is going, and let's see what the Fed has done on that end.
Now, are there going to be some callbacks to Bostic's language and some of the other, I don't know, maybe slippage that these Fed speakers had when they used the T word, tapering? Because a couple of weeks ago, that kind of slipped out a few times, Lara.
That discipline is something that is always tough when you've got so many Fed speakers. And I think it just speaks to the fact that we've gotten so complacent with the Treasury market that there is actually room for volatility there that could be more broadly disruptive. I feel like Powell has upped his game. He's been in the role now for 4 years. So I think he's really, been better about maintaining discipline, but there is always that risk when the other Fed speakers get involved. I think the Fed, more than anything, is keeping us focused on the fact that right now, the risk in their eyes is that the economy gets worse. They are fully focused on supporting the economy, not worrying about removing any of those supports.
What's the most compelling, concerning piece that Powell can put forward as reason to keep going here? I mean, I know that we've got cracks in the employment situation. We've seen that there are still folks jobless. I mean, look around. It's not a surprise, right? Everything's closed. But Lara, what else can the Fed really do at this point, apart from just waiting for us to reopen? I mean, it seems like most of these jobs, not all, but there's some permanent jobs. It seems like most of them should come back once we're open.
Yeah, when I look at the economy right now, the analogy that I'm using is taxiing for takeoff. We are definitely stuck on the tarmac right now. Expectations for 2021 are strong. We just have to get through the first quarter. So I think that's what the Fed is seeing. To your point, what can they do about it? That is really a tough one because they've driven long-term interest rates low. Clearly the Fed funds rate, that's at the floor. There's really nowhere to go there. And then you're talking about supporting markets, which seem to be pretty well supported. What I think the Fed now pivots to is focusing more on working with the Treasury, seeing what they can do. I love that you called Powell and Yellen the dynamic duo. I think that's very, maybe not in character, but hopefully in coordination. They'll really be able to, I think, get a little creative. If the economy needs further support, they are going to have to get really creative in how to do it.
I like the taxing before takeoff, Lara, especially when we've got the vaccine now and the curves are going down. So the logic should be that once they go down, they don't quite go up again like they did in the past. So maybe a few little moments here and there. I don't know. I'm not the epidemiologist, but it seems like it's pretty straightforward that once we go down and we get vaccinated, we shouldn't be dealing with the same types of explosive numbers that we've seen in the past ever. So the taxing seems like the conclusion is takeoff, right? You get in the plane and you know you're going to take off eventually. If we know we're going to take off eventually, how do we connect this back to the investment side from the bond side? I mean, if Powell's ready to help us accelerate if we're waiting around for longer, and if he doesn't, then that means we're going to take off at the time we expected, then why are we holding bonds? Why are we buying bonds these last 2 weeks? It seems like one CPI that didn't show a little hyperinflation. Everybody just went right back to this bond trade.
I think this is the classic conundrum of markets, which is, in theory, they're pricing in all of the information. And if they have been so optimistic about growth, they don't wait to see the growth to price that in. It's already priced in. So I think a lot of these people who have been talking about some big reflation trade with long-term yields going higher, that may very well be more of a 2022, 2023 story, because you've got the Fed on the other side of that trade. You're sitting on the trading floor, you're trying to find the right time to sell bonds and rotate into something else, or to go, to push deeper into equities, but you're trying to decide between growth versus cyclical. All of these questions are really, I think, the idea that 2021 is going to be strong is already been internalized by the markets. So what I see being an issue is some unexpected volatility in this bond market that we always assume is this rock solid, steady animal. I think that we could try to push the 10-year higher. If we get good data, CPI will go up in April, May. Those are the base effects of last year's crash, kind of CPI decline, working themselves out. That could cause long-term yields to rise. Inflation expectations could get rocky. At the end of the day, with the Fed on the other side, that could be where the volatility comes from. And it could hit equity markets as well.
Lara, I like the reminder here that because of the event from last spring, that the natural percent change on these CPI year over year is going to be a big number on its own. And then the fact here that we've got a lot of, again, just kind of language around, well, what I hear from guests is, well, the Fed is going to be able to keep things together and keep things from moving too quickly because they're going to have certain language around it. The only catch I see to that is that the language has been here since August. Yields have gone up, and it seems like it's just the market still determines where the 10-year yield goes. It seems like the market still is the one who determines based on inflation expectations. I mean, am I missing something here?
No, you're absolutely right. And I think, we have to keep in mind that in the first quarter, we're going to get a Treasury refunding report that's going to include, over $1 trillion of new debt that they need to roll over and issue. The U.S. has never had to worry about supply concerns when it comes to debt. Usually markets effortlessly absorb all of the treasuries that we need to print out and to sell. That may finally be hitting a wall as well. So I feel like there is a confluence of events between CPI naturally rising, supply dynamics, inflation expectations, to your point, at the end of the first quarter, if we get some really rock solid good news, we really get those vaccines into arms, we could get some movement higher in interest rates. 1% to 2% this year is totally realistic, but it might not be a straight line. And that's where I think we may get surprised by some volatility in this complacent, sort of placid treasury market.